Hello and welcome to Chapter 5 of Accounting 501. Today we're going to talk about sales and receivables. Sales and receivables is really what we're doing is we're kind of going down the balance sheet for for a business. And what we're going to talk specifically about, the first thing we're going to talk about is revenue recognition. These are our learning objectives. We're going to measure what net sales revenue means, and there's going to be some deductions off of that. Particularly something called sales returns and sales discounts are the two we're going to look at. We're going to look at the different types of receivables, the most common types of receivables. We're going to figure out how to measure and interpret bad debt expense and also the allowance for doubtful accounts. We're going to discuss the implications of cash flow for accounts receivable. And we're going to look at how to account for notes receivable from the inception into maturity. In other words, from when they start until when they're finally due. And we're going to look at control procedures because a lot of accountants need to know this. And many of you guys in your business context, even if you're not accountants, understand that you have to do something to control for merchandise sales. And finally, we're going to look at some different ratios that deal with profitability and asset management. With no further ado, let's take a look. Revenue recognition is kind of an accounting term. What it really boils down to is it's really there's two things that determine whether you can recognize revenue. If it's realizable, if it's realized or realizable, in other words, can we get the money out of it? And second is when it's earned. So if you've done something. So realizable means that you're reasonably certain that you're going to be able to get it. And the second thing is that you've actually done the work in order to receive that money. So revenue recognition is one of the first things we want to talk about. And remember, we're talking specifically about accrual-based accounting here, not cash basis accounting. Cash basis is not GAAP and accrual basis is. So with the context of what we're going to talk about is accrual basis, even though we also touched a little bit on cash basis. Criteria set by the SEC when you can recognize revenue, that there's pervasive evidence that there's an arrangement, a contract, a purchase order, or something like that that actually shows that what are the details of the exchange. So what would that mean? If you are a person that's in customer service in an organization, that would mean that you've got a purchase order and an agreed upon price from your customer, and that the delivery has occurred. And the delivery can occur in two different ways. If you sell a product FOB shipping point, which means you're selling it from your plant or your warehouse or your distribution spot, in effect, once that truck leaves your distribution facility or your warehouse, it's the ownership, it's owned by the buyer. You can also have FOB destination, and FOB destination means that when it arrives at the buyer's warehouse. So it's your product until it's then. And there's some stuff you might talk about with inventory. It's really considered part of your inventory when it's in transit if it's FOB destination, whereas if it's FOB shipping point, it's considered the buyer's product already. The other two things, the two bottom points that are just as important, is that there's a price or the price is determinable, and it's reasonably certain that they're going to collect that money. Those are criteria that are set by the SEC. Revenue recognition continued. The amount of revenue recognized is generally in cash, and we'll set it up more often than not in a receivable. And if we have sales, sales really has three components. In addition to sales revenue, you have regular sales revenue, but then you have changes to it, which are discounts, returns, and allowances, and each have a different character to them. Let's touch on some of those. Sales discounts. Sales discounts are given to customers so that they will pay faster, because that would mean that the supplier, if you're the business selling the product, gets their money faster and they have use of their money faster. So it's a reduction in the selling price, but in the long run, the seller gets their money faster and the buyer is willing to pay faster because they get that reduction. And typically it's going to be anywhere between 0.5% up to 3%. And we'll talk about that more here in just a second. So here's one of the terms you might see on an invoice. And this is a typical set of terms. You can have terms that'll say this 2/10 N/30. As you can see, it says 210 net 30 is how you would read that. But really what it says is if you pay within 2 days, within 10 days, you can take a 2% discount on the invoice. So if you have a $1,000 invoice and you pay within 10 days, if you have a $1,000 invoice dated January the 1st, and if you pay by January the 11th or sooner, you take a 2% discount on on that invoice or $20. And the seller would record that as an expense, and the buyer would record that as a some kind of a revenue. Typically, this next point here, most companies record the sale at the gross method pre-discount. So in the example I just gave you, if you had a $1,000 invoice, you would report sales revenue at $1,000 and accounts receivable at 1,000, and then you wouldn't report the discount until it's paid, because if they pay within 30 days, you're not going to get the discount. And that's typically what they're going to do. And the sales discount account on the bottom, I don't want to get this minimized. It's a contra revenue account. What that means is the normal balance of a sales discount account is a debit. Most revenue accounts, all revenue accounts, with the exception of sales discounts, sales returns, and sales allowances, their normal balance is a debit, not the normal balance of sales revenue accounts is a credit, but those other three accounts, discounts, allowances, and returns, are all debits. They're contra, they're opposite, they're debit balances. And so I'm not going to spend much time on this slide. You might want to pause the slide here for just a minute and read this, but we're going to talk specifically about sales discounts. And we have different journal entries, and I'm going to go through the journal entries on the next page, and we'll talk about each one of them just on a quick step by step so you follow this logic. The first one they said is they wanted to record the sale, and I won't worry so much about these little boxes over on the right. That's the accounting equation stuff. But let's focus specifically on these journal entries. So the first one says that they reported the sale at a gross level. So they sold stuff for $15,000. They reported a receivable for $15,000, and they reported sales revenue for $15,000. That's when they sold it. On the 15th, it appears that the customer paid and they took a discount. So what happened is they got a check in. The seller got a check in for $14,700. You notice 10 days, because the discount was 210 net 30. So they get in 2 days. It was probably 210 net 30, excuse me. So the calculation here is 2% of this, 0.02 times 15,000. You can see it here. Is $300, and then the difference is 14,700. So we reduced the receivable by 15,000, but when we increase cash, an asset, and we have this contra revenue account called sales discounts for $300, and that's what would happen. Now, if you notice, this is collection within the discount period. Later on, down here, it says collection after the discount period. No discount is given, and they didn't pay. So that's the scenario, and you notice gross method, not the net method. The net method would look a little bit like this, but it would be different in that, and you have to pardon me for a minute, the account names would be different. So this would actually be accounts receivable, and it would be on the 5th, by the way, not on the 15th. The net method would look like this would be accounts receivable. This would be sales discounts, 14,700 and 300, and then sales revenue of 15,000. Let's go to the next one. So sales discount. It's important to monitor sales discounts, because if customers have continually taken sales discounts and they've stopped, that might suggest that the business is starting to get in financial trouble. And also, it may impact your business from a cash flow planning perspective, because you don't have the money that you would normally need to run your business. So you want to monitor what's in that discount account, and make certain that that's the case. Now, sales discounts are different. These things on the bottom, these last 3 points, are kind of interesting. Sales discounts are distinguished from trade and quantity discounts. So the trade discount is really a reduction in the selling price. So you're selling something on deal. And sometimes they call that promotions in most businesses. They might say, I'll give you $1 off per case if you buy a certain during a certain period, let's say, right? And another one is a quantity discount. And more often than not, you'll see that when you're buying limited quantities or greater quantities. Think of it like if you were a college student and you wanted to buy t-shirts, and you said, I want to buy one t-shirt instead of one t-shirt, and it's a custom t-shirt for your fraternity or sorority. Well, they're going to charge you a given price for that t-shirt. That's going to be fairly high because of all their costs. But once you get past a certain point, they're going to sell those t-shirts to you at a lower price, and it's really based off of the volume of what you purchased. That's what a quantity discount is. That's the differentiation between these two. The sales discounts is really an early pay discount. Trade and quantity discounts are really driven by what happens in the trade. Sales returns and allowances. This is a little different than sales discounts. A return and allowance is when there's something wrong. Many of you guys probably buy stuff off of the internet. And when you buy it off of the internet and you get it home and you say, well, it looked like it was black on the internet, but it's really a super dark blue. And you call the supplier to complain and they say, well, sorry, we made a mistake. We sent you the wrong one. But if you keep it, we'll give you $10 off on the price. That's going to be an allowance. A return, on the other hand, is send it back and we'll give you your money back. So those are the two different things that give you something a little bit different based off of what the condition of the product is. A return is an out and out return taking back of the product. An allowance is some kind of a price adjustment for some type of defect in the product that you have. That's the distinction. And both of those accounts are contra revenue, which means that they're going to have a debit balance, not a credit balance. What are different types of receivables? There's really three different types of receivables. You have accounts receivable or notes receivable. The difference is, and sometimes accounts receivable are also going to be called trade receivables because you're expecting money from customers. And accounts receivable are generally current, and they're going to be 30 to 60 days is when you're going to collect it, maybe even sooner depending upon the kind of product you sell. Whereas and accounts receivable does not have interest associated with it, where notes receivable does. And notes receivable is going to be anywhere from 3 to 12 months. And you notice here trade receivables, which accounts receivable would fall into that category, are due from customers purchasing inventory in the ordinary course of business. And non-trade receivables arise for not involving inventory. So a non-trade receivable, just a simple one would be, let's say you bought 10 acres of land to build a business, and you determined that you wanted to sell 5 acres of that land, and the people you sell it to agree to pay you back on a note. That would be a non-trade receivable because it has nothing to do with your core business and it's not part of the normal course of business. Accounting for bad debt. First, let's just talk about what bad debt is before we go. Bad debt is when you extend credit to somebody and they can't pay it. That means accounts receivable. You do something to give people money or give them credit and they can't pay it. It's considered a bad debt. I know most of you guys know that. And sometimes it's called uncollectible accounts. And there's two types of bad debt expense. One's called the direct write-off method. The other is the allowance method. The direct write-off method is not GAAP. Okay, sorry, I'm jumping around here a little bit. Is not GAAP. They wait until they are 100% certain they can't collect it, and then they will write it off. Think of this like a little mom and pop plumbing shop that they do work for somebody, and it's a husband and a wife. The husband does the plumbing work, and the wife does the bookkeeping, and they go and do work for somebody, maybe an in-law or somebody they know, and the people they think that they're going to pay, they think that they're going to pay, and they think that they're going to pay, and finally 18 months or 2 years later they say they're never going to pay. My ex-brother-in-law is not going to pay. They have to write it off, and when they write it off, that they take it out of the receivable and they debit the bad debt expense account. There's no allowance method and allowance part in this, and it typically is it's not GAAP, it's immaterial under GAAP, and it's also they can use it but only if bad debts is immaterial under GAAP. But more often than not, it's going to be businesses that are not following GAAP. They're probably much more cash basis type accounting. And you'll see this in small businesses more than anything else. The next one is called the allowance method. And in the allowance method, in the bad debt write-off, the first one, the direct write-off method, does not follow a good matching principle where you're matching revenues and expenses. The allowance method allows you to match revenues and expenses because you are estimating how much money you expect not to collect. Because if you extend credit to businesses, more often than not, you're not going to be able to collect a certain amount of money. And that's why you have to have this allowance account. The allowance for doubtful accounts account is a contra asset, a contra receivable account. You're going to take accounts receivable less allowance for doubtful accounts, and that will give you your net receivable balance. So if you were to look at financial statements, say for Cisco Systems, they might say accounts receivable net on their financial statements. But if you go back into the notes of the financial statements, you are going to see that it says accounts receivable, the core balance, and then they'll tell you the allowance for doubtful account balance. And they make an estimate of doing that for different reasons. So that's what they do. Okay. And when they determine that it's not collectible, then they're going to write it off, and there's a different way to deal with it. And I'll show you that here in a minute. So the percentage of credit sales, they're going to take this percentage of credit sales, and they're going to say if we sell $1 million worth of credit sales, maybe we're going to have 5%. And that's this little formula on the bottom. So if you have $1 million in credit sales, that would be this number. And they say 5% is what they expect not to collect. So you're going to take $1 million times 0.05, which would give you $50,000. And that's what your bad debt expense is. What you're going to do, the journal entry, we'll look at it in a minute, is we're going to debit bad debt expense for $50,000, and we are going to credit allowance for doubtful accounts for $50,000. And here's a little example of that, little different numbers. And I'm not going to spend a lot of time here. Let me just cover a couple things. $620,000 and 1.43%. Let's go to the next slide. Same again, like I did before. You might pause and look at this. But let's take a look. The first thing they did is they had $620,000 times 0.143. So their bad debt expense, the expected bad debt expense, is $8,866. And that's one thing. The second one is they had a write-off. And when they did this write-off, what they did is they went to this contra asset account, this allowance for doubtful accounts, they debited it, and they credited accounts receivable. Again, don't worry about this stuff on the side. And then on the last one, they did this entry. So they wrote something off here. They found somebody that couldn't pay. And then here, they used this calculation to post the entry, 8866. Okay? And here's the T accounts that looks like it. Had a beginning balance of 0. They had and bad debt expense. They did the adjustment for 8866. It looks like they had a $134 credit balance in the allowance for doubtful accounts account at the beginning of the year. They wrote off 524, so they had a balance of 390. They made one adjustment for 8866. The ending balance is 8476. But you notice something. The balance of the accounts, the net receivable, which we talked about just a little bit ago, the net receivable balance is $295,000. And that $295,000 is the same, just you notice that the distribution is a little bit different based off of this $524 write-off. Now the aging method is a little bit different. The aging method assumes that the older something is, the longer it's outstanding, the longer you haven't paid for it, the less likely you are going to be able to collect. So we can look at something called an aging accounts receivable, and it's really a percentage of receivables balance that we're looking at. And we do it by buckets. They call them aging buckets. If you ever work in accounts receivable, what they're going to do is they're going to pull accounts receivable by age, 0 to 30 days, 30 to 60 days, 60 to 90 days, and greater than 90 days. And if you were working in accounts receivable, you would have to collect, you would call and try and collect on those receivables on the one. So here's the same setup. I would encourage you to pause here for a moment and take a look at all this stuff. But the things I want you to notice here is that 224,000 in accounts receivable. They had some sales, they had some collections, and they had some write-offs. But the difference here, I want you to be careful of something. The difference here is now we are going to establish a balance that we have to back into. And you'll see what I mean. So here's all of our journal entries in the T account format. We had a beginning balance in accounts receivable 224. We had credit sales of 3.1 million, and we had collections of 3,015,000. We had $60,000 worth of write-off. So our accounts receivable balance is $249,000 before adjustment. We had 67 in allowance for doubtful accounts. We had write-offs of 67,000. So we have a net debit balance right now in the allowance for doubtful accounts, $53,300. The calculation says that we should have 60,500 in there. Our goal is to have a balance of 7,200. So we need to make an adjustment to get to the 7,200 because the 7,200 is the calculation based off of the aged balance, and you can take a look at that in the requirement section. So we need to back into what this 60,500 is so we can make our balance 7,200, which is, let's go back, is really what we want to have our ending balance. Here it says 7,200 is what we want. So we need to back into this number based off of this, and that's the difference between these two, gives us that $60,500. And here's what the journal entry looks like for that. We're going to debit bad debt expense, and we're going to credit allowance for doubtful accounts. So you look at the two, the difference, what's different about them? The first one is the percentage of credit sales is primarily bad debt based off of the income statement, and the percentage of credit sales, the aging, it's is is based off a balance sheet. So this one's a income statement approach, and the bottom one is a balance sheet approach. Um, uh, are bad debts always bad? The answer here, what I would tell you, you can read through this, but the answer here is no, they're not always bad because if you never have bad debts, what that tells you is your credit policy is probably too tight and you're probably losing sales. Some salespeople would say that the credit department is a sales prevention department because they say, oh, the sales guy went out and they made a great deal to sell to a customer they haven't sold to in forever. And the credit department goes and looks at it and says, no, they are not credit worthy, so we cannot extend them credit. So they're the sales prevention department. And sometimes if your credit policy is too restrictive, you may lose sales and you do not have, and it's not a good thing. This next part, something called factoring. As opposed to going through all this stuff, let's talk what a factor would do. And I'm going to give you an example so you understand what a factor does. Imagine if you were a furniture company and your main purpose in life is to sell furniture. So what you do is maybe the 1st of October, people want to buy furniture to get their house looking pretty before the holidays. So when all their family comes, they'll go buy furniture. Well, the furniture store says, okay, I'm going to sell this furniture, but I don't want to have to try and collect all that money because they'll say, we'll extend you credit, 90 days same as cash or 2 years same as cash. Well, what they're doing is they're actually taking in receivables that ultimately they're going to turn around and resell those. And they're going to sell them to a third party that's going to collect on them so that they can get more money to buy more furniture. And when the factor buys them, what they're really doing is they're buying them at a discount. Let's say they turn around and they sell $100,000 of receivables to a factor, and they sell them to that for, say, $97,000. Well, the furniture company is happy because they get $97,000 cash so they can go out and buy more furniture. The factor is happy because they're going to charge interest on that $90,000, $97,000, and they're going to collect on it. So it's a way for sellers to get money out of their receivables. Now, this next one in the bottom here is securitization, where they bundle a bunch of stuff and turn around and sell the receivables. And they're financial instruments that are actually traded on the open market. Two different things. The factor stuff is really small scale. The securitization is really big scale stuff. And they did this a lot with like home mortgages and that sort of stuff. And that's where Fannie Mae and the mortgage industry got in a lot of trouble. So cash management and credit cards. Companies use credit cards. When you use a credit card at a store, the the company when you get that credit card, the company is Visa and Mastercard, for example, and American Express. They make money two different ways, and I'm not going to go through all this, but what happens is the credit card companies make money on the interest on your outstanding balance, and they also make money every time you swipe your card. So if you spend say $50 on something at Kohl's, if you bought it with your Visa card, Visa will take 3% off of that, and Kohl's will recognize $50 in revenue. 3% off of that, say a buck 50, will go to Visa, and Visa will send Kohl's 48.50, and they'll get a buck 50 from Kohl's for the right to have their machine in their store. But then, so the credit card company makes money two ways. They make it from Kohl's on that service fee, and they make it from you. And what are the advantages? The advantages for a company is a credit card sale is like immediately like a sale. It's like a cash sale because they get their money very fast from these credit card companies and they guarantee it. And there's less record keeping costs, and their sales will definitely increase. Um, and that's a really good thing for the for the retailer that accepts credit cards. Debit cards is kind of the same thing. I'm certain you're familiar with it. It's really kind of the same thing. The only difference is you have to have money in your bank account to take out with a debit card, whereas a credit card you don't. And typically there's going to be the same. There's going to be some type of a fee that the company charges for you to use your debit card. You won't see it, but the bank will. A note receivable. Notes receivable has a principal and interest, just like your car loan would be a note receivable. A little bit different, but you have certain amounts of money, and it has a maturity date, an end date, and you might have principal and interest. And typically, some of these they don't pay a payment of principal and interest. They might only pay them at the end. How do we calculate interest? Interest is equal to principal. Interest dollars is equal to the principal in dollars times the interest rate times a portion of the year. If it's a whole year, it would be one. If it's, let's say it's half a year, it's going to be 6 divided by 12, 6 months divided by 12. The interest rates are always presented in a annual number, never in a fraction of that. So you're taking the principal times the interest rate. So if I had $100,000 and I had 10% interest and I had 6 months for the year, I would take 100,000 times 0.06. If it's excuse me, times 0.10 times 6 divided by 12, which would be zero point 0.5. So you'd say that the interest would be $5,000. 100,000 times 10%, or zero point 0.1 times 6 divided by 12 for half of the year, so it would be 5%, or $5,000. And here's some journal entry stuff. You might pause here. I'm gonna go to the next one. And here's some transactions. Let's focus in on the left side of the screen again. You'd made a sale, 50,000 and 50,000. And they said, wait a minute, I can't pay. They said, will you convert that to a note receivable? Sure. So the company converted it to a note receivable. And then what happens is they have interest income on that note receivable. It looks like it's 10% per year. So there's principal times 10% times 12 months over 12 months, so 1 year, and it's $5,000. That's similar to what we just talked about. And here it is for half a year, 250. And they have interest receivable and interest income. And then down here you have cash, notes receivable and interest income when they pay. And they have cash, notes receivable and interest income when they pay at the end of the year. So these are two different transactions. And then here's this last one. And you can just follow exactly what happened. They set up a receivable and they had more interest income because it was another 3 months. So the calculation here is going to be 3 divided by 12 times 50,000 times 10%. So it would be 3 divided by 12 times 10% times 50,000, where this one comes from. It's a quarter of the year. Then they have the receivable that they established earlier that they're going to collect because they didn't collect it until 2013, and they cancel all that out. And when the person pays them, they pay $56,250. Internal controls for sales. There's going to be several different documents, and they're not highlighted in here, but let me point them out to you. You have a purchase order, you have a billing document, which really goes along with the truck, and also goes um, if it goes with that, and those are billing documents. And then there's a receivable that goes in with all that stuff. So you have the shipping document, which is really called the bill of lading. And it says billing documents, which is really an invoice. So this would be like a bill of lading that goes with the semi. This would be a purchase order, and this is going to be a billing document. In a small business, you might see all of these bundled. In a big business, it might be on a computerized system. And so here's an example of the purchase order, a shipping report, and it says bulk manufacturing. This might also be a bill of lading, and then an invoice. Each one of these kind of creates an invoice packet, and it all supports this particular transaction. You notice what's not here though, and a lot of times you'll see this. What's not here is also The other part, if it's a perpetual inventory system, you would have a debit to cost of goods sold and a credit to merchandise inventory. You don't see that in this transaction, but that's what you'd have. Now, if we look at sales, we're going to look at gross profit, which is sales less cost of goods sold is gross profit, divided by net sales, and we come up with a gross profit margin. And operating margin is operating income divided by net sales and net profit. All these are just ratios. And what it does is it allows you to do common size analysis of different businesses that are within the same industry. Excuse me, and people like to look at that. Looking at receivables, this just tells you how efficient businesses are doing at turning their receivables. And you look at accounts receivable and it says net sales divided by average net accounts receivable. Average net accounts receivable is just the accounts receivable divided by 2. Beginning of the year, end of the year, beginning of the month, end of the month. And it just tells you how many times they're collected, how it's collected. And what you might compare this back against is what are the credit terms of the business? Because that will tell you how many times they're turning their business and what their actual days payable outstanding or days outstanding are. And here's some calculations for gross profit. I'm not going to go through all this stuff. I'm going to stop here and you can take a look at these calculations and read through them. I would pause on this one and pause on the next one and just take a look. And that's it for this particular presentation. I look forward to chapter 6. I hope you have a great day.